Prices at the grocery store and the gas pump aren't just normal inflation. They are all tied to what I'm calling the Hormuz Shock. There is a tiny 21-mile strip of water that's currently blocked, trapping 14 million barrels of oil every single day. It's created a hidden, invisible tax that's hitting your wallet directly. While the rest of us are paying the price, the big money players are already making moves to profit from the chaos. Today, I'm cutting through the noise. We are going to look at the main three things you need to watch on your charts: the predator stocks that are making a killing, and the prey stocks that are looking really dangerous to hold. Let's get into it. Part 1. The mechanics of invisible tax. When the strait faces friction, global shipping insurance fees explode. With around 25% of global oil trapped, supply vanishes, pushing oil towards $126 a barrel. Oil is the primary cost for moving everything on Earth. When it jumps, transport companies pass the cost to you. Every purchase you make now carries an invisible tax, a hidden premium to cover the fear that stopped the oil from moving in the first place. And it's not just your gas tank anymore. By trapping 30% of global fertilizer exports alongside that oil, the blockade has ignited a second wave crisis, a global agri-food shock. This is the invisible tax evolving from a temporary fuel surcharge into a permanent fixture of your monthly household budget. Now, let's check out the 3 indicators you need to watch on your chart. You don't need an economics degree to see where the crisis is going. Just track these 3 indicators on your chart. The first one, Brent Crude and the ceasefire illusion. Brent is your panic gauge. Markets have been whipsawed by a ceasefire illusion. News of the potential deal pulled prices towards $92 per barrel. But conflicting signals from Washington and Tehran keep the strait contested. As of late May, the strait remains effectively closed to most commercial traffic. Even if a deal is signed, critical infrastructure has sustained serious damage, keeping the risk premium high. If the oil breaks above $110, the system is breaking down. The second indicator is the shipping cost. Watch global shipping benchmark. If open shipping rates skyrocket, the bottleneck is worsening. It's an early warning that grocery and retail inflation will rip higher to 30 to 60 days down the road. Look at the Freightos Baltic Index chart. The line is clearly trending upwards, which tells us cost to ship goods across the ocean is getting more expensive every week. And the third indicator, the safe haven shift. Watch gold and US dollar. If they rise while stocks are slump, big money is heading for a cover. The market is currently narrow, supported by only few tech pillars like Nvidia, Apple. If the big money flees, these few pillars could crack, causing the index to crumble much faster than normal. Part 3. Predators and Prey. In this $120 oil environment, money doesn't just vanish. It aggressively moves into different pockets. There are clear corporate predators capitalizing on this chaos, and highly vulnerable prey getting left behind. So let's begin with some preys, the operational casualties. The first one are the airlines. Fuel accounts for a massive chunk of their operating cost, and they have been shredded by Hormuz bottleneck. Spirit Airlines is the definitive casualty here. Unable to survive the invisible tax of surging fuel prices and failed bailout efforts, the company officially ceased all operations on May 2nd. The second one is the retails. Giants like Walmart are facing a double whammy. While they have seen revenue growth, higher fuel costs are directly eating into their profit margins because they are forced to absorb those expensive transportation surcharges. Even with shoppers still spending, the outlook is clouded by the fear that consumer demand will falter once tax refunds dry up. Let's get on to the predators now, the institutional favorites. The first one is energy. Oil majors like ExxonMobil and Chevron act as a direct hedge against the crisis. When global supply drops, these giants capture the price spread. ExxonMobil alone pulled in $8.8 billion in adjusted profits in Q1 of 2026. They aren't just surviving, they are using this volatility to print historic cash, which they have funneled into billions of dollars in stock buybacks and dividends for their shareholders. The second one is defense. The defense complex is seeing a surge in demand as global conflict intensify. Companies like Northrop Grumman and Lockheed Martin are seeing consistent inflows because their revenue is anchored by government-backed contracts, not consumer spending. Northrop Grumman, for example, is seeing double-digit growth in its missile and ammunition segment, and investors are pouring capital into these firms as the safest sanctuary in a volatile market. The third one are the discount retails. Finally, watch the off-price giants like the TJX companies. History shows that during the economic slowdowns, these retailers thrive because middle-class families are forced to trade down to find bargains, as the invisible tax restricts household budgets. TJX captures the market share that big box retailers lose when consumers become more price sensitive. Now, what's the takeaway of this video? Geopolitics is a direct hit to your portfolio. If negotiations stall, capital will continue rotating into defensive fortresses like energy and defense. But Hormuz is only one piece of puzzle. If you want to see how this interacts with massive aerospace volatility we saw mid-month, check out my deep dive, The Beijing Shockwave, linked on the screen. It covers how the US-China summit upended the tech sector. Protect your cash, watch these 3 indicators that I've just spoken about, and click the link in the description for the free invisible tax cheat sheet. See you in the next briefing. Thank you.